Welcome, everyone, to This Explainer. We've all been there, right? You quickly type out a message, you hit send, and instantly you realize you made a massive typo. In a sheer panic, you just mash that unsend or delete for everyone button. It's a total lifesaver. But what happens when we scale that up? I'm talking about the global financial markets, where billions of dollars in stocks and derivatives are moving every single second. Is the price of a typo out there totally final, or is there some hidden way to take it back? Well, today, we're exploring a seriously fascinating and kind of overlooked reality of global finance, the multi-billion-dollar undo button. Okay, let's dive right into this. Section 1, the market's undo button. Can you actually unsend a trade? As investors, we're generally taught that free markets are built on the absolute sanctity of contracts. Once a buyer and a seller are matched, that's it, done deal. But when you really dig into the microstructure of markets, a totally different reality emerges. You see, the legal foundation of these systems actually places the security of the overall market way above any individual contract. So, can you unsend a billion-dollar trade? In our everyday lives, deleting a text is just a nice convenience. But in the ultra-high-stakes world of global finance, the power to cancel a massive, already executed trade is a tool of immense power wielded by global exchanges. It's basically their ultimate failsafe. We can think of this as an emergency brake, or quite literally, an undo button. It's the power of exchanges to just cancel executed trades worth tens of billions of dollars to keep the whole system from collapsing. Now, how this gets applied really depends on where you're trading. In the US, for instance, there are highly standardized, strict rules for quantitative trading. If a price deviates past a specific threshold, boom, the system automatically triggers a review. But over in some Asian markets, there's actually a lot more discretionary power. Exchanges there might look beyond just the math and consider broader factors, things like overall market order, investor protection, and settlement risks, before they decide to yank that emergency brake.
Moving on to Section 2, who pays for mistakes? The fat finger phenomenon.
Let's move to and see how this builds, because if trades can sometimes be canceled and sometimes they can't, who actually takes the massive financial hit when things go wrong? Well, let's look at the infamous fat finger. It's a classic term in finance. A fat finger is simply a keyboard or algorithmic error that results in massive, completely unintended trades. It's the ultimate whoops moment, but, with millions or billions of dollars on the line. To really grasp the rules of liability here, we need to look at two historic examples. Take the 2005 JCOM event in Japan. A trader at Mizuho Securities had a pure slip of the hand. They accidentally tried to sell 610,000 shares for 1 yen each. Actually, scratch that, they meant to sell one share for 610,000 yen. The broker panicked and immediately tried to cancel, but the Tokyo Stock Exchange's system suffered a major failure and couldn't process it. The result? The courts ruled the exchange had to pay 70% of the massive losses because their system failed to let the broker stop the bleeding. Now, contrast that with the 2013 Everbright event in China. Everbright Securities had an internal glitch that instantly dumped billions of yuan in buy orders onto the market. They literally begged the Shanghai Exchange to cancel it. The exchange said no, pointing out that their matching system worked perfectly fine. Everbright had to eat 100% of those losses themselves.
So the crucial point is this golden rule. Who pays depends entirely on whose system broke. If your firm messes up, but the exchange's matching engine is humming along just fine, you are entirely on your own. You pay the price. But if the exchange's system fails and prevents you from fixing an error, then the exchange is on the hook.
Section 3, the LME nickel storm, systemic threats, and the ultimate climax. Because what happens when the firm making the mistake is so big that eating the loss would bankrupt them and take the whole market down with them? Just think about that number for a second. $12 billion. In 2022, the London Metal Exchange, the LME, faced an absolute, unprecedented crisis. The price of nickel violently spiked to an absurd $100,000 per ton. So the LME stepped in and slammed their undo button, directly canceling $12 billion worth of executed trades. Now, as you can probably imagine, the hedge funds holding long positions, the folks who stood to make billions from that spike, were absolutely furious. To them, the fundamental sanctity of the market contract was broken. They literally described the LME's actions as being like a casino dealer canceling the winning draw just because the house was losing. From their point of view, they made a bet, they won fair and square, and the exchange cheated them out of their payout. But now, what's really interesting about this is the LME's perspective, which all comes down to the role of decentral counterparty. See, the clearinghouse acts as the buyer to every seller and the seller to every buyer. It is the absolute glue that ensures the entire system functions. If the LME had let those trades stand, it wouldn't have just been a few traders losing money, it would have triggered a catastrophic systemic failure. Let's quickly walk through the exact domino effect the LME was terrified of here. Step 1, nickel prices artificially spiked to that crazy $100,000 mark. Step 2, because the price is so high, a massive wave of short sellers cannot cover their positions and they default in mass. Step 3, because the central clearinghouse is the counterparty to all those defaulted trades, it absorbs the blow and completely collapses. Step 4, the entire market faces systemic ruin. This right here is exactly why the UK courts ultimately upheld the LME's decision. They ruled that an exchange's primary duty isn't making sure one hedge fund gets its payday, it's preventing this exact four-step path to market death. The exchange kept its emergency powers. Though it's definitely worth noting, the LME was still heavily penalized later for the poor risk management that let the situation get so bad in the first place. Section 4. Prevention. Pre-trade risk. Stopping errors before they start. Because regulators would vastly prefer that these radioactive errors never enter the market at all, the financial industry had to learn this the hard way back in 2012. Look at this staggering metric. 45 minutes, $440 million. That was the terrifying reality for the American firm Knight Capital. A runaway high-frequency trading algorithm went completely out of control, and before anyone could even pull the plug, it hemorrhaged nearly $500 million in under an hour. It was a massive wake-up call for the entire global financial sector. And this brilliantly illustrates the absolute critical need for what we call pre-trade risk controls. These are automated systems designed to intercept abnormal orders and physically lock down accounts before the trade even reaches the exchange's matching engine. Global financial systems quickly realized that having an after-the-fact undo button just wasn't enough. They absolutely needed a centralized authority holding an emergency risk switch at the very front door of the market. Which brings us to Section 5, the free market's fundamental contradiction, the illusion of absolute freedom. We've looked at fat fingers, massive metal market cancellations, and pre-trade locks. When we synthesize all these case studies together, a really fascinating philosophical battle emerges. On one side, investors naturally demand absolute freedom. They want a purely free market where a deal is a deal no matter what happens. But the cold, hard reality is that markets absolutely require system stability. They demand a centralized emergency fuse to survive panics and black swan events. The undo button is basically the ultimate institutional compromise between the freedom to trade and the sheer necessity to survive. And that brings us to our core takeaway from today's explainer. Free markets are never absolutely free. The freedom we enjoy to buy and sell at lightning speed is entirely subsidized by the hidden safety net managed by centralized institutions. Without someone standing by to hit that emergency brake, the entire architecture of global finance would simply be far too fragile to function. So, I want to leave you with a provocative thought, especially as we look to the future. With the rapid rise of cryptocurrency and decentralized finance, we constantly hear the phrase, code is law. It's proposing a system with absolutely no central authority and zero undo buttons. We've seen experiments like this globally, but based on what we've unpacked today, we really have to ask, does removing the central authority actually grant us ultimate freedom, or does it just saddle us with a dangerously fragile system lacking an emergency fuse? When the next multi-billion-dollar typo happens in a completely decentralized world, who is going to step in to stop the collapse? It's a huge question the financial world is going to have to answer very, very soon. Thanks so much for joining me on this explainer, and keep questioning how the systems around you really work.